Okay, Bon, all of you. So this is the way that now today we have the MCQ test, right? So first morning we will have the lectures from 8 to 9:30. 9:30 we will schedule the MCQ test here, right? That will be a half an hour test, right? And after that we will continue the lectures. Okay. So now first we start the lectures, right? So can you remember what we talked about in the last day, last week? Actually, we talked about the ISL length, right? So we started our discussion. Last week we talked about the LN curve, right? Which represent the money market, right? So can you remember? Otherwise, okay. So I don't know the online participant that voice is not clear. So there it's clear, but moving other sides, problem is the voice. Right? Anyway, so we give the priority to the physical, you know. Yeah, I think only one participant is there online. So lastly, LN curve, can you remember the LN curve? So we divide the LN curve, right, based on the money market equilibrium. So as we discussed, we know that LN curve represents the money demand and the money supply, right? And it's upward sloping, we divide based on the money market equilibrium. Right. So highlight the important factors, two factors, right, regarding the slope of the LN curve. Right. Now, very important, right? We look at this LN curve. We look at basically we look at the slope and the position. Because what factors determine the slope? That is very useful when we are talking about the policy effectiveness. So we know that there are different policies that we implement, right? After we discuss policies, right? So when we look at the policy effectiveness of the monetary or fiscal policies, we need to worry about the slope of the curves. So therefore, we will discuss the slope of the LN curve. Right? Now that depends on the two factors. Right? Now we know that LN curve, money demand and the money supply. Right? So the money market. Right? Money demand curve, we know that downward sloping. Right? Which depends on mainly the income and the interest rate as we discussed. Right? And remember, transaction, precautionary, speculative model, right? That determines the money demand. And the money supply is the other factor, right? The money market, other variable, right? So that's actually determined by the central bank. Right? So that's we identified as a policy variable. Right? It's an outside exogenous variable. That's why when we talk about the money market, we know the money supply curve, vertical money supply curve. And remember, it's vertical, right? So because it's determined by the central bank, it's exogenous variable, outside variable. Right? So then if you look at now, money demand is downward sloping, money supply is vertical, right? So what is the most influential factor in determining the income and the interest rate? They are based on money market, the money demand, right? Because money supply curve is vertical, that is fixed. Right? So therefore, when you look at the money demand curve, you may remember that we highlight the equation for the money demand. Right? Money demand C0 plus C1y minus C2r. Right? Can you remember? So we mentioned the money demand. You need to. Can you remember the money demand? We C0 plus C1y minus C2r. No? Right? Right. So the C1 and the C2 that determine the slope of the money demand, which in turn determine the slope of the LN, C1 and the C2. Because in explaining the variation in the slope of the LN curve, mainly the money demand is the causal main factor that goes to determine the slope of the LM. So when you look at the money demand, the C1 and the C2 is mostly can determine the slope. So that in turn determine the slope of the LM curve as well. So the C1 is the income elasticity of money demand, right? C1, so that related with the income, right? And the C2 is related with the interest rate, right? So that is the interest elasticity of money demand. So those are the two factors that determine the slope of the LM, whether it's steeper or flatter. Right? Sometimes the LM curve becomes steeper, sometimes it becomes flatter, right? So then mainly goes by income elasticity of money demand and the interest elasticity of money. Those are very important. Now, whether the income elasticity or the interest elasticity of money demand can be high or low. We need to look at when the slope of the LM curve when there is a high or low income or the interest elasticity of money demand. So the thing is right now the outcome is here larger the C1. If there is a high interest, so income elasticity of money demand, there will be a steeper LM. And the other side, the C2. The C2 is high, there will be flatter LM and vice versa. So that is the main factor. Now if you look at this situation, right? So we assume the first we take the income elasticity of money demand, right? C1. So that determines the relationship between the income and the money. How far the money demand is response to change in the income. Right? So what is the percentage change in money demand due to percentage change in the income? So the responsiveness of money demand due to change in the income. Right? So that sometimes the C1 can be low or high. Right? Then if we take first instance, right, as an example, if there is a high value of income elasticity of money demand, if the C1 is high, what happens? So we take the small rise in the, we assume small rise in the income. Right? So C1 is high, we assume high C1. So if there is a small rise in the income, so that if the C1 is high, there will be a faster rate of change in money demand after the transaction and there is a greater effect on money demand due to more rise in income. So what happens? Now we can recall the memories in the money market. Income increase, money demand under the transaction and proportion note is increased as a result of that. And portion, right? Because we assume C1 is high. Right? Then money market is in equilibrium or disequilibrium? That will be a disequilibrium situation, right? So if there is a rise in the money demand, so there is excess money demand in the money market. Money market is imbalanced, right? The money supply is constant, it is a policy variable, right? Then there should be adjustment in the other side, the interest rate, right? In order to equilibrate the money market. So there will be a rise in the interest rate as a result of that. Right? So there is excess money demand, there is a pressure on money market, right? So that pushes up the interest rate. So in order to equilibrate the money market, right now there is a higher money demand, excess money demand due to the transaction and proportion note. Since there is a rise in the income, more portion, right? But to equilibrate the money market, there should be higher greater impact on the interest rate. The interest rate will increase at a faster rate. Right? In order to absorb the excess money demand in the money market. Right? So when there is a rise in the interest rate, what happens? Money demand under the speculative motive decline. Right? So there is a negative relationship. So that means money interest rate increase until this excess money demand comes to zero. When the interest rate increase, money demand decrease. Right? So the money market comes to the equilibrium. Right? So what happened? Small rise in the income, faster rate interest rate. So what is the slope of the Ln curve? Because Ln curve represents the relationship between the interest rate and the income, right? At which the money market comes to the equilibrium, right? Where the money demand equal money supply. So smaller rise in income and faster rate in interest rate. So that implies steeper flatter. That implies steeper Ln curve. We have to compare these changes, like the interest rate and the so if there is a steeper Ln curve means we know that like, steeper Ln curve. So if there is a steeper Ln curve, this is the interest rate and the income, no? Right? So Ln curve is steeper. So we have the this is the Ln. Small changes in income from Y0 to Y1, but interest rate adjustment is greater, right? So that means we have the stable Ln, right? So that is the situation that we can observe under these circumstances, right? So if there is a C1 value is high, no, right? We know that there will be a steeper Ln, right? And if the C1 is low, there will be a flatter Ln curve. Flatter Ln curve. If the C1 is very low, there will be a more flatter Ln curve. Right. Is it clear? So just you have to take this relationship, right, based on the money demand, and you can identify the situation, right? So under the circumstances of C1 high or low. Right? So as we discussed in this situation, right, what we observe, if the C1 value is high, there will be a steeper Ln. Situation, right? Now we see here, right, smaller.
Actually, some of the survey check right.
Right. So smaller rise in the income, but higher adjustment in the interest rate that we see, right? Under the circumstances. C1, right? Then we move to the other one, right? C2, right? C2. So that is the interest elasticity of money demand, right? So which explains the relationship between the interest rate and okay, right? So then you talk about the C2. So that is the interest elasticity of money, right? The responsiveness of money demand due to change in the interest rate. Right? Now here we know that normally there is a inverse type relationship. If there is a high C2, there will be a lower or the flatter Ln. If there is a low C2, there will be a steeper Ln. Now here we assume the lower C2 value. If the Yes, it is right. What happened? So C2 is low, right? So under that circumstance, you can see the assume if there is a higher rate of change in the interest rate, right? Interest rate increase at a faster rate, right? By portion, no? Right? So you rise in the interest rate at a greater percentage, right? If there is a low C2 value, right? If there is a low interest elasticity of minimum, what happens? There will be lower percentage of declining money demand under the transaction and deposit. Rise in the interest rate faster rate will cause reduce the money demand by a smaller portion because C2 is low. Right? Now the money demand reduced. Right? So therefore, what happened? Small portion has come. We know the equilibrium market, right? So there should be a rise in the income, right? Because that money demand will be increased again. You would equilibrate the money market. So we see a small rise in the income. Let's look at the relationship, right? So now higher percentage change in interest rate, but lower percentage change in income. Right? So that will result in steeper elevation. Right? So the way around now this kind of solution, right? Same thing, no? Right? So that is the steeper elevation. And if the C2 value is high, normally we get flatter elevation. So under that the C2 is high, we assume there is a smaller rise in the interest rate that will cause to faster decline in the money demand, right? Under the transaction and proportion model, right? So there should be a equilibrium in the money market, so the adjustment should be in the equilibrium income. So there should be faster rate rise in the equilibrium income in order to equilibrate the market. With higher change or rise in the income, we need to increase the transaction and proportion of the demand under the transaction and proportion faster rate. So that will offset the decline in the money demand due to rise in the interest rate under the money market. So other way around, no, right? So taking the relationship, small rise in the interest rate and faster rate in changing income. So that will result in better. So we can understand the two factors, right? C1 and the C2, so that determine the scope of the element, right? So remember, right? So now sometimes you may give, right? Assuming the high value of the interest rate, right? So when we explain the policy effectiveness, right? So we need to look at all these aspects, right? So when we explain the policy effectiveness of the impact on the interest rate income, right? So and we analyze the situation, right? So when there is a monetary or fiscal policies, right? So basically we look at the impact of the income. So we look at the policy effectiveness. So therefore that will basically caused by the scope of this situation, right? So C1 and the C2, those are the responsible factors in determining the scope of the element, right? Now it can be steeper, it can be flatter, no? Right? We have the flatter LN curve. If the C1 is low, no? Or C2 is high. We have the steeper LN curve. If the C1 is high, or C2 is high. So that operating opposite direction. This is the final results, right? The C1 is high, we have the steeper LN curve. If it is low, we have the flatter LN. Right? If the C2 is high, we have the flatter, and if it is low, we have the steeper LN. Right? So those are the two factors that determine the slope of the LN. Right? Okay. we can look at the special case. So now here we take the C2, right? So that means the interest elasticity of money demand, right? So there can be extreme situation. If the C2 is 0, what happens? If the C2 is infinite, what happens? So those are the two cases that we can talk about, right? Based on the argument in economics, right? Based on the classical school's argument and Keynesian school argument. Since you highlight the classical economics, right, very much, right? We talk about the classical economics, right? But I will explain the details, right, regarding these two arguments, right? So based on the interest elasticity of money demand, extreme cases, right? Now C2 is 0, so that means 0 interest elasticity of money demand. Can you imagine the situation under that circumstances? If the C2 is C2, what happens? Now that is our C2, right? If this C2 is 0, what happens? If this C2 is 0, what happens? Now, if this C2 is 0, so this whole part becomes 0, no? Right? Right? So then money demand explained by C0 plus C1Y, right? Only the transaction and precautionary motive mainly explain the money demand. So that is the classical economics. They believe money acts as a medium of exchange, right? Money has a neutral role in the economy. Money does not explain the money. There is no role played by the money in determining output or employment. Money is not responsible to determine the output. That is the classical argument. So money, neutral role of the money explained by this money demand function. If the C2 is 0, so that means 0 interest elasticity, right? So there is no response, no, right? Coming from the interest rate, no, with the money demand function, no, right? If the C2 is 0, no, right? So that means with whole part we can ignore, right? Money demand is explained by C0 plus C1Y. So that explains the transaction and precautionary motive of money demand. So that is the case that we identified as the classical case, right? So under these circumstances, LM curve become vertical. LM curve become vertical because now if you look at the what? If we take now money market equilibrium, we know that, right? Money demand equal money supply, right? At the equilibrium situation, right? Now the money supply, money demand function is C0 plus C1Y, right? This is the money market equilibrium, right? So under the circumstances of 0 interest elasticity of money demand. So if you take the Y in terms of Y, if we explain what happened, money supply, that means minus C0, right, divided by C1. So this is the equilibrium, right? Money market equilibrium, right? Okay. This is the money market equilibrium. Under that circumstances. So now since the money interest rate is not respond, no, in determining the money demand is not respond to change in the interest rate. So interest rate has neutral effect on the money demand, right? So if you look at the LM curve under this circumstance, it becomes vertical because even though the interest rate change, now this is the Y equal minus C naught divided by C1 at this point. Right? So this is the LM curve, right? So even though the interest rate, income does not change, no? Right? So since the interest rate has neutral role, right? So if there is an effect coming from the interest rate, that will change the money demand, right? There will be impact on income, but here no impact coming from the interest rate on money demand. So the LM curve becomes vertical under that circumstance. Okay. So if the C2 is 0, LM curve becomes vertical. Right? So if the LM curve is vertical, right, monetary policy is not effective under that circumstance. So we can realize it later, right? When you talk about the IS curve, right? When you talk about IS curve in first month, right? So that is the situation. That is called now classical case. Under the classical case, LM curve become vertical since the interest rate has no independent impact in determining the money. Okay. Right. So this is basically coming from the classical ideas. So money has no role to play in the economy, right, other than acting as a medium of exchange. So that means most of the real problems in the economy can be answered without the money. So that is the main argument coming from the classical. Money is not important in determining output by output. So this is the C2 0 case, right? Zero interest elasticity of money. The case is C2 infinite. So infinite interest elasticity of money demand. Sometimes without change in the interest rate, money demand can be totally changed. Okay? If the C2 is infinite, C2 anantaya form. What happened? C2 infinite. Infinite interest elasticity. So this is called now that is the classic Keynesian case. Keynes identified this situation as a liquidity trap. So interest elasticity, that is called liquidity trap. Liquidity trap, right? So if the C2 is infinite, right? So under that circumstances, the economy, the interest rate prevail at a very low level. In the money market, interest rate very low level compared with the normal situation. So that kind of situation, right, we identified as the Keynesian case, right? So under that, C2 is infinite, right? So here other way around, LM curve becomes horizontal. So under these circumstances, right? So under these circumstances also, if the LM curve is horizontal, monetary policy is also not effective, right? Now, to look at so this is the money demand and the money supply, right? The economy is running it at very low level of interest rate, right? Under these circumstances. So this is the equilibrium in the money market, right? So there is a low level of interest rate, money demand function become horizontal, right? At this situation. Right? So even though the money demand increase due to rising the income, right? Because people are living with the expectation, right? So if there is a lower interest rate, what happens? We expect interest rate will increase, right? So if there's a rise in the interest rate, right, there is a situation, right? What happened? There is a small rise in the interest rate that will reduce the bond prices. That will reduce the bond prices. So if there's a reduction in bond prices, that will make capital losses for the bond owners, right? So therefore, so under that circumstances, right, we see somewhat horizontal money demand curve, right? So now we see money demand increase slightly due to rise in the income, right? But interest rate not respond under that circumstances, right? Economy is running with a very lower level of interest rate under the liquidity trap situation. But under the normal situation, if there is a high interest rate situation, right? So this is the money demand function, right? At high level of income. So there is a great adjustment in the interest rate we see, right? So under the liquidity trap situation, economy, the money market rates or the interest rate is very low, right? So yield curve become horizontal under this situation, right? So there also we see the monetary policy is not effective, right? So I'm not going to explain those things because we can discuss it later, right? Effectiveness of monetary policy, right? So you see, as I mentioned, right? So the money demand curve is nearly horizontal, right? Under these circumstances, right? So it is a very low level of interest rate. The money market, right? We identified as a liquidity trap situation, right? So compared with the normal interest rate, right? But at a higher interest rate, we see the adjustment in the right? Higher income level, right? We see higher adjustment in the interest rate under the normal circumstances, right? But in the liquidity trap situation, interest rate is very low. Right? So that is the Keynesian case, right? So where we can identify the two extreme cases in the C2. C2 can be 0 or it can be infinity. C2 0 case means a classical case, right? And the C2 infinity means the Keynesian case. So when there is a liquidity trap situation. Okay. Is it clear? Now, right. Any question? Right. So that's, I think that's okay enough, right? So you can just remember the C2 0 and the C2 infinity case, right? So where we highlight the two arguments coming from economics, right? As well as the Keynesian, right? Arguments that confirm by this C2 0 and the C2 infinity case. Okay. So that is the slope of the LN curve, right? So the slope of the LN curve mainly depends on the C1 and the C2. Right? So then we look at the position. So what factors cause to shift the LN curve to the right or left? So what are the factors? Now we know that money demand mainly C2 and the income. Now you know the LN curve represents the various combination of the interest rate and the income, right? At which the money market come to the equilibrium, right? So that explains the relationship between the interest rate and the income. So when you look at the other factors, we have the money supply and the money demand function, we have autonomous money, right? And you can think about the money demand function C0 plus C1y minus C2y. That is the money demand. So the C1 and the C2 associated with the income and the interest rate. So those are the two estimated variables in the LM curve, no? Which represent the relationship between the interest rate and the income. Right? Other than that, there is C0, autonomous money. If there is a change in the autonomous money demand, what happens? That will shift the LM curve to the right or left. Other factor is the exogenous variable, money supply. So if there is a change in the money supply, that also goes to shift the LM curve to right or left. So those are the shifting factors. Right? Because in the money market equilibrium, we derive the LM curve based on the money market equilibrium, right? So the money market equilibrium occurs when money demand equal money supply. So money supply is a policy variable, we take this as, right? Money demand, we take it as C naught C1y minus C2r, right? So these factors explained in the LM curve, basically we derive the LM curve, right? That explains the relationship between interest rate and income. So we have the C naught and the money supply. So those are the shifting factors. So if there is a change in the C naught and the money supply, LM curve shift to left or right. No, right? So those are the shifting factors. Then you need to know about how the change in money supply, that is the monetary policy variable. Money supply, not the money stock. Right? So how it is affected to the LM? So if there is a rise in the money supply, what happens to the LM curve? If there is a decline in the money supply or decline in the money stock in the economy, what happens to the LM? Right? So likewise, if there is a change in the money demand function with autonomous money demand, right? So what is the impact on that shift? Right? So now we can look at the shifting factors, right? If there is the money supply. So normally if there is an increase in the money supply, right? So that will shift the LM curve to the right. So if there is a decline in the money supply, so that will shift the LM curve to the left. Right? So that is the change in the real balance also, right? Now MOV means real balance, right? Now sometimes that is the money stock in the economy, no, in real terms, right? Now this is the N is the money in nominal terms, so we divided by the price level, no? So we can ascertain the real money stock in the economy. So there can be increase in there can be change in the real money stock due to inflation, right? So if there's a rise in the price level, no, right? Then the price level, real money balance increase, right? So that means money stock increase, that will shift the LM curve to the left. Right? Sometimes central bank increase the money supply, no, right? So that will increase the nominal money stock, no, right? So that will shift the LM curve to the right. Right? So those are the change in the money stock, right? So if there is a increase in the money supply, that will shift the LM curve to the right. Okay. And the other one is money demand function, right? So that is mainly the money demand function, shifting the money demand function mainly explains the change in the autonomous money. So that is explained by C no, right? Okay. Now under what circumstances this autonomous money demand can be changed? So we know that if there is a crisis situation, right? So if there is a political instability, right? The financial crisis, right? Economic crisis, and there is some kind of economic stability, right? In the economy, and if there is political instability, right? So those factors goes to change the money demand function. Right? So that means those factors goes to change the autonomous money demand. So those are the other factors other than income and the interest rate, which goes to money demand. Right? C not mean other factors. Right? So, we identify the money demand mainly depends on the income and the interest rate. Other than the income and the interest rate, what are the other factors which affect the money demand is explained by the autonomous money demand. C not. Right? So those are the political factors, economic factors, other factors, external factors, crisis situation, macroeconomic imbalance, right? So if there is changing such factors that create what happens? Uncertainty and the risk, right? If there is a macroeconomic instability, that increase the uncertainty and the risk. That's the same for financial crisis. Right? So we don't know what will be happening in the future. There's uncertainty. That will create risk. So that what happens? If there is a great uncertainty, that causes the business right, to liquidate, bankrupt. Right? So then what happens? If the business goes down, company is failed, right? Bankrupt, liquidate, then what happens? That will affect the bond, right? Bonds. Right? People don't rely on the bonds. Right? There will be a lower demand for bonds. Are you going to buy shares if there is a problem in the economy, uncertainty in the economy, correct in the business, right? What we experienced last time, right? Share market decline. So because we assume basically how people keep their assets, right? In two forms, right? Assets, part of the assets is kept by the money and the non-money, right? Money plus non-money. Right? Now your wealth, assets is your wealth, right? How you keep your wealth? Part of wealth you are in monetary terms, right? You have the money with you, money with your banks, right? And other one part is the non-money, right? Now, according to Keynes, assets people like to keep the money and the bonds. Non-money explained by the bonds, right? Right? In our explanation. These the bonds, right? Now what happened? Assets is 100, right? So if you keep the 50 money and you keep the 50 bonds, likewise, right? Now what happened due to this uncertain situation? Now political instability, there is a conflict in the political parties, there is a civil war situation, right? If there is a war tension in the economy, that will increase the political instability, right? So people, they are not going to buy demand bonds, right? Because that affects the business, If there is uncertainty, right? People like to keep more money with their hand, right? Not the bonds, money, right? So under that circumstances, there will be an increase in the money demand, right? People keep money, not the bonds, right? If there is an uncertainty, right? Okay. So that will increase the money demand, right? So we can discuss that situation, right? Now we assume there is no change in the income. Now this is the initial situation, right? Now you have to, when you are coming to explain graphically, right? You need to first you have to think about the initial situation, then you incorporate the changes, and you see what kind of impact on the income or the interest rate or the prices. Right? Now at the initial situation, money market is in equilibrium. You have to change this line. So then the other direction, right? R0 is the zero particular interest rate. The money market is in equilibrium at Y0 income level and R0 interest rate. So that is the point here we see, right? At R0, so there is no change this side. R0, Y0, okay? Right. You can make it correct, right? R0, Y0. So that is the initial situation. This is the, what is this? What is this? What is this? LN curve. So this is the initial LN curve, right? Okay. So what happened now? Now due to rise in the other factors, right? Political instability, maybe, right? As we discussed, there will be a rise in the money demand due to rise in the autonomous money demand. See, no, right? Because now here money demand increased, right? So because of this, people who would like to demand bonds, right? There is uncertainty in the economy, right? People then give more money. According to our analysis, assets comprise with the money and the non-money. and one is the bonds. Right? If there is a lower demand for bonds, it will uncertainty. People like if no money in their hand. So money demand increase, right? There is no change in the income, right? Income remain by zero initial situation, right? But due to other factors, money demand increase due to the increase in the autonomous money demand. Money demand function shift to right is given by NB one or something by zero, right? So if there is a rise in the money demand, we know that interest rate increase from R0 to R1. So the money market equilibrium moves from here to here. We say here E, A to E. Likewise, B to C. Likewise, if there is a change in the autonomous money demand. Right? Now, at R1 interest rate, same income level. Right? So you can see R1 is the higher interest rate than R0. R1 here, right? But what happened? Same income level. So we can have another point here. Right? Point here. So if you draw the line, right? So you see LN curve shift to the left. Right? So if there is a rise in the autonomous money demand, what happened? LN curve shift to the left. Okay? Is it clear? Is it clear? As we discussed, right? Now we will take only one point, no? Right? To derive the curve, right? Initial point is here at R0, Y0, right? So that is the initial point. Now we assume income does not change, but due to other factors, no? Autonomous money demand increase, money demand comes to the right. To equilibrate the money market, there is a rise in the interest rate, right? So the new interest rate is R1. At this point, R1, Y0, same income level. So we can take another point here, R1, but same income level, Y0. This is the point. Right? So if you draw the LN curve, based on that, we see LN curve shift to the left. Right? So if there is a rise in the autonomous money demand, or shift in the autonomous money demand, changes in the autonomous money demand function. So if there is a rise in the autonomous money demand, LN curve shift to the left. If there is a decline in the autonomous money demand, LN curve shift to the right. So those are the shifting factors. So mainly the money supply and the money autonomous money demand. Right? Okay. Right. So now we talk about the slope of the LN curve and the position of the LN curve. Right? Slope mainly depends on the C1 and the C2. Position depends on two factors, money supply and the autonomous money demand. So if there is a rise in the money supply, that will shift the LN curve to the right. If there is a decline in the money supply, that will shift the LN curve to the left. If there is a rise in the autonomous money demand, that will shift the LN curve to the left and vice versa. Okay. So then we are moving to the IS curve, right? So that is the other side, no, right? In our so what is the IS curve? IS. So as we discussed IS, so that explains the real sector, no, right? So I mean the investment. S mean what? Savings. Right? I mean investment and the S is savings. So investment and the savings, right? So those are the factors which represent in the real sector, right? So IS curve represents the real sector equilibrium. So the goods market equilibrium, right? Okay, right? So it shows the equilibrium in the real sector because I mean the investment, S means the savings. Right? We know that investment function. What is our investment function? That depends on the interest rate, no? Right? And the savings depends on the income, no? Right? So our saving function, you know that S equals minus A plus 1 minus B y D, no y, no? Right? Right. So what is our investment? Investment function, we can write it as I0 minus I1R. Right? So this is our investment function. I0 means what? Autonomous investment. Right? So this is the autonomous. R is the interest rate. I1 is the interest elasticity of investment, no? Right? Interest elasticity of investment. Right? So mainly we assume interest investment depends on the interest rate, right? So there are other factors, no? Right? We discussed in the earlier, no? Right? Maybe the income, maybe the expectations, policies, no? Government policies, no? Right? Right? So which determine the investment, right? Here we assume the business investment, no? Right? Business investment, right? So that mainly depends on the interest rate. In our analysis, we assume interest rate. Investment mainly depends on the interest rate. It's negatively related because you know that this negative side, no? If there is a rise in the interest rate, we know that there will be a decline in the investment. No? Because interest rate is the cost of capital. You know, right? Cost of capital. Higher cost of capital means lower projects will become viable. Right? There is high cost of capital. Right? That reduces the viability of the projects. No? Right? So that means that decline the investment. So now I1 is the interest elasticity of investment. Right? So that is explain the sensitivity between the interest rate and the investment. That's also a very important factor because that determines the slope of the investment curve. Right? So in our IS curve, right, investment curve that depends on the interest rate, savings depends on the income. So if you look at the savings, the slope of the saving is 1 minus B, no? Right? What is it? What is 1 minus B? Marginal propensity to savings. PS. Right? Yeah, identify the consumption function A plus B by D, no? Right? Where B is the marginal propensity to consume, no? Right? MPC. Here 1 minus D means MPS, no? Right? Okay. Marginal propensity to savings. Right? So that is the factor that determines the slope of the saving function as well, right? So this IS curve represents investment and the savings. Right? Okay. So it shows the various combination. IS curve was to explain the various combination of the interest rate and the income at which the real sector equilibrium, right? Goods market equilibrium. Right? So it shows the goods market equilibrium where aggregate demand equal aggregate supply. How do you explain the real sector equilibrium? There are two conditions for equilibrium: macroeconomic and relative. One is the aggregate demand should be equal to the aggregate supply. Other one is the injection should be equal to the recovery. Right? Now we can assume different forms, no? Right? Oh, right. In the IS curve, right? In the real sector equilibrium, one is the, we know that aggregate demand equal aggregate supply or expenditure, right? Other one is injections equal withdrawal. In a simple economy, injection means investment, withdrawal is the savings, no? Right? So I R S Y. So we can say I R plus G equal S Y plus T, no? Right? So that is in the government, no? Right? We go to the open economy, exports, and we had imports as well, no, right? So these are the different. All these explain the injection should be equal to withdrawal, no, from the simple economy to the complex economy, right? So those are the two conditions, no, right? Now, when you talk about the real sector equilibrium, right, it satisfies all these things, no, right? Aggregate demand equal aggregate supply, injection should be equal withdrawal, right? So we can, when you form the IS curve, we can assume these different forms, no, right? We can derive the IS curve based on simple economy, two-sector economy, open economy, like that, right? But we are not going to discuss all these things, right? Only we look at the simple thing, right? So we take the simple economy, but some complicated, we can incorporate other sectors. Government, no? Government taxes, and plus the interest cost. So there is an equation also how we derive the equilibrium, right? We are not going to talk about all these things. We can explain all these things using the equation, mathematics, right? Yes, we can derive, right? We will have an equilibrium. The multipliers, the highest level, all these things we can discuss. Like we discussed in the case in one, we are also we are going to talk about these things, right? So now here we know that now if we take a simple I equal S, right? Interest investment depends on interest rate, saving depends on the income. Now in our IS curve represent the R and the Y, right? So Y is there in the saving function, right? Interest rate is there in the investment, right? Here we assume investment is a endogenous variable. Endogenous variable. Within the model. Right. Now we are going to discuss the ISL, right? In the real sector equilibrium, right? So equilibrium is the use market, and equilibrium in the real sector. We know that when aggregate demand equal aggregate supply, injection is equal aggregate demand equal aggregate supply, we can write it from that. In this way also, y equals sigma psi plus d. Y equals sigma psi, y equals sigma psi plus d, y equals sigma psi plus d, exponent z. Right? This is simple number to the operation of the number, right? So here we assume the gross economy, right? Y equals C, Y minus D means we know that consumption depends on the disposable income. Now we take the disposable income by D, Y minus D. So we can write C, Y minus D plus I plus I. Okay. So that is the equilibrium. Right? Other way around is the injections equals with O, I plus D equal S plus D. Right? Okay. How we derive the IS curve? Earlier we derived the LN curve, right? Can you remember? We derived the LN curve based on the money market equilibrium. Since the LN curve represents the money demand to money supply and represents the equilibrium in the monetary sector. Same way now IS curve represents the equilibrium in the real sector, the goods market. Yes, those variables there. Right? Now we can derive the IS curve based on the two curves, no? Investment curve, savings. Right. That is also we can do other way around it. We can derive the LN curve based on the Keynesian explanation, based on the Keynesian cross. From that on Keynesian cross. So what is the cross? Aggregate demand and the aggregate supply. That is the Keynesian cross. So anyway, you can derive the IS curve, right? Basically, we derive the IS curve based on this Keynes ideas, right? And even the LN curve also based on the Keynes money demand, money supply. Right? So that's why we say, like I said, normally provide The base is provided from the Keynesian model. It's a building block of the Keynesian model. Further extension of the Keynesian model to represent the real and market sector interaction. So IS curve, that it represents the negative slope between the interest rate and the income. Right? So there are represent the real sector. Right. We are going to derive the IS curve, right? Now IS curve, right? So we know that output, interest rate, right? So those are the equilibriums, right? That we are going to talk about. Equilibrium interest rate, equilibrium. So that we talk about based on the this part of equilibrium. So I equal E. The initial situation, right? Because one is the 45 degree line, equilibrium income, otherwise use this Keynesian cross, right? To derive the IS curve. Now this is the equilibrium income curve, right? Aggregate supply curve, right? This is the aggregate demand curve, right? E, Y, R means aggregate demand, right? So we know that slope mainly depends on the P, right? This equation, equilibrium, we can identify when aggregate demand equal aggregate supply at the point A. And then determine the equilibrium income IC, right? So we take that one point here, right? Because we are going to derive the IS curve. So we can identify, so this aggregate demand curve, right? So we know what are the variables here? C plus I plus T, right? E means aggregate expenditure means C plus I plus T. That depends on the, there are consumption that depends on the income or disposable income. Investment depends on the interest rate. So we assume particular interest rate, initially the R0 interest rate, right? So particular income level and the R0 interest rate, right? So at this equilibrium, we know the interest rate is R0 and the equilibrium income is Y0. So we can take from that. One point we can here. So we can assume it's R0 is the higher interest rate, right? At this point, we have a particular income Y0. Now suppose what we assume here, interest rate decrease from R0 to R1, right? Interest rate decline, right? If there is a decline in the interest rate, what happens? That will increase the aggregate demand due to rise in the investment demand, right? If there is a decline in the interest rate, we know that investment increase that raises the aggregate. So therefore, shift the aggregate demand curve upward to the right. So moving on here. So we can take another equilibrium and point B. The equilibrium moves from A to B. So as a result of that, because there is a decline in the interest rate from R0 to R1, right? Then we raise the aggregate demand, we rise the investment demand, that shift the aggregate demand curve to the right. So the equilibrium moves from A to B. Right? So that is we can identify those 2 points. Now the first point we can take point A, right? At R0 income level, Y0 income. Right? So R0 is a higher interest rate than R1. We go higher level, right? And Y0 income. Right? R1. So R1 is this point, right? E, Y, R1, right? So as R1 interest rate is a lower interest rate than R0. Right? So our income level moves from this up to Y1, right? R1 by 1, another point. Right? Based on that, so those are the 2 points, equilibrium points, right? In the Keynesian cost. This is the Keynesian cost, right? Aggregate demand, aggregate supply. It's downward sloping, right? So these points, any point on the IS curve represent the clear sector equilibrium or the goods market equilibrium, right? So based on the goods market equilibrium, where aggregate demand equal aggregate supply, where injections equal withdrawal, right? We derive the IS curve, right? Okay. It's downward sloping, negative slope from left to right, right? So that represents higher the interest rate, lower the income, like kind of relationship, right? Right. So this is the, right? Now we can take now any point of this IS curve, what happens? Aggregate demand equals aggregate supply, and injections equal withdrawal. If it is a simple economy, investment equals savings. If it is a closed economy, projections I plus D equal S plus D, right? In open economy, I plus D plus X equal S plus D plus X, right? So any point of these IS curve, right, represent equilibrium. Where aggregate demand equal aggregate supply, injections equal. Now if you take that point C, what happens? Point C is the below the IS curve. Below the IS curve, what happens? There is excess demand. There is a greater demand than the supply. So there is excess supply of goods. So excess demand for goods. Excess demand for goods. Any point below. Okay. So any point on the IS curve represents the equilibrium, right? There is no excess demand, excess supply, but above or below, there is this equilibrium. We take the below point like point C. Point C means Y less than E. Aggregate demand is higher than aggregate supply. Point C. There is excess supply of goods. Any point above the IS curve, so here excess demand for goods, right? Any point above the IS curve, other way up. There is excess supply of goods. Okay? Right? We take the point D. Why? That means aggregate supply is greater than aggregate demand. Right? So those are the not the equilibrium points. So if there is excess demand, normally there should be a rising income, right? If there is excess supply, there should be a decreasing income. Right? Now, if you use investments and the savings. Right now, if you draw the now, this is our investment function, right? Now we can derive the IS curve based on the investment and the savings, right? Now we know that our investment function is it depends on the interest rate, right? So this is our investment function, right? So, okay, and the savings. This is our savings. Sy minus t, right? So I don't have the pen, right? That's why. Like, so, say my black. Okay. Like Tibanis. Right. Okay, right. Now we are going to derive the IS curve based on the investment and the savings, right? Now this is our investment, right? Okay. Between the interest rate and the investment, no, right? Now if we take the lower interest rate, right? R0, we have the higher investment, no, right? Okay. Now R0 is the lower interest rate. We have the high investment rate I0. So we know that I0 means there's a high savings, no, right? Okay. So high savings that will associate with the higher income, right? Okay. Right. Now if we take another point, right? R1. Higher interest rate and there will be a lower investment, right? So lower investment associated with the lower I1 savings that will associate with the lower income. So lower income Y1, right? Okay. Now we just relate the things, right? Is it clear? Now R0 means lower interest rate. We know that at the lower interest rate there will be high investments. High investment means higher savings. I0 and S0 means the equilibrium, no? Right? Injection is equal with level I0, S0, right? If there is a high investment, high savings, it will associate with higher income level, right? So that will give 1 point. R0, Y0. R0 here, Y0 is here, right? Point, right? 1 point, right? Okay. And R1 is the high interest rate, lower investment, right? Lower investment as well with lower savings, that means lower income level. So high interest rate R1, right? So the lower income level Y1. So we can derive the IS curve, right? So that is based on the investment and saving. Very simple, no? Right? Right? So this is our savings, right? It's upward sloping, right? That depends on the income, no? That depends on the disposable income Y minus T, no? Right? Okay. Sy minus T means disposable income, right? So based on that we can derive the investment, save in IS curve, right? So that also we here noted downward sloping, no? Negatively sloping, right? Okay. So that's the way we derive, right? IS curve, right? So we can use the Keynesian cross for investment savings curve, right? We can derive the IS curve, right? So now all these things we can draw in one graph also, right? Because in a one graph, right, we can explain all these things, right? Now these axes are very important, right? Now here this is I equal investment and the savings, right? So this is Y, right? So this is Y, the R, right? Okay. R and I, right? Because now here savings related with the income, right? Now, okay. Now we can draw this one in a one graph as well. Like this. Now in a one graph, right? All these things we can represent. So this is the R and the I, right? R and S, R and Y. Right? Now this is the investment, no? Right? So this is the I equal S equilibrium, right? So this is the savings, SY minus T. Okay. Now we can same way like we did earlier, right? So we can assume lower interest rate, right? R0 as if with the particular investment, higher investment. It associates with the I equal S. So that determines the income. I0. So one point we can take, right? Like the charts, right? And that's same graph, right? So same thing explained different. This is the equilibrium, no? I equal S. So investment, this is the savings, no? Right? Particular interest rate that determines the investment. I equal S. I0 S0 is equilibrium. This is 45-degree line, right? So that determines the savings. That will determine the income, right? And this income level is savings, no? Right? Savings mobilized for investment. Other way around also we can explain. So this is the point, right? One point we can identify here. And high interest rate R1, lower investment. So I2 became, so that is S2 something, that is Y1, right? R1, right? So this is the IS12. Likewise, in the one graph you can explain incorporating investments, savings, right? It's very interesting, no? If you actually need to you know these things, right? You need to keep in your mind, right? Just read the graph and see the relationship. So this is the now we can clearly explain with the simple economic, right? We can incorporate government sector also, right? In the course economic model, right? I plus dx plus c, right? So we know that this is the explanation, right? Based on that, right? You can incorporate government, right? Aggregate demand curve in the government sector, right? Earlier we aggregate demand is simple economic, now we assume the government sector, right? If there is a government, right? Earlier the investment decrease from R0 to R1, right? So the aggregate demand curve shifts to upward shift and to the right, right? So we can derive the IS curve based on that. So that is in the graph, right? Right? Right. Derive the IS curve based on the savings and the then we can discuss the slope of the IS curve, right? slope. So what determines the slope? So whether we have the steep IS curve or the flatter IS curve. Right? So that mainly depends on the savings and the investment. Right? Because when we derive the IS curve, we use the investment and the savings. So the slope mainly depends on the slope of the savings function and the slope of the investment function. If there is a steeper investment curve, we have the steeper IS curve. Right? If there is a saving function is steeper, that also affects the IS curve. Right? Now, what determines the slope of the investment curve? That is interest elasticity of investment, I1. Right? So that is one factor close to slope of the IS curve. Right? So that means slope of the investment function and the slope of the saving function. Right? Slope of the investment function mainly depends on the I1. Slope of the saving function mainly depends on the LPS. No, right? We came to the exam. Right? So those are the two factors. No, right? Very simple, right? So slope mainly depends on the slope of the savings and the slope of the investment. So what determines the slope of the investment function? Interest elasticity of investment. Saving function slope mainly depends on the LPS. So those are the two factors that goes to slope of the IS. Interest elasticity of investment, marginal potential savings. Okay. Now, if you look at the slope of the investment function, that is the interest elasticity of investment, right? So, what is the slope of the, now if there is a I1 is, I means what? I1, I1 here, I1 can be high or low, right? High I1 means what? So that is the determine the slope of the investment, no? Right? Now the investment function can be steeper. Okay? This is the investment. So that means what happened? This is more now. Even though the interest rate increase, if there is a steeper and the flatter, right? Steeper investment curve. So that means we know that interest rate is not highly respond to change the investment, right? I1 is low, no, right? Here I1 low. If there is a flatter means that will goes to change, no, right? So I1 high, no, right? If the I1 is low, we have the steeper investment curve. So that affect to the steeper IS curve as well. If the I1 is high, we have the flatter investment curve. So that goes to have the flatter IS curve as well. Okay. So likewise, now we can identify the slope of the investment curve. So that depends on the interest elasticity of investment. Exactly. So shall we have the example, right? After that we will continue the lecture, right? So we have the how we start the exam, okay, right? So we'll have the half an hour, right? Once we open the session, it will, right? It will be given half an hour. You need to answer 25 questions. Okay. simple questions, right? Don't take it too seriously, right? You can answer all the questions. Yeah, I will give you the password, right? It's the password. So don't see the others, right? You can do it yourself, right? In bona fide, no? Right? In group three, right? So you will get different questions, right? Right? Different answers in shuffle way, right? So if you see the others, right? Sometimes you may confuse, right? Therefore, don't look at the others, right? You can do it in your own way, right? Okay. So now the login password is given 6367, right? 6367, okay? So that is the login password in LMS, no? I think you know that. So he will assist you, right? So if there is a problem, right? So the password is 6316 to the LMS. You can. So now you can go to the LMS site and you can use the login password 6367. You can access to the LMS MCQ platform by using the password 6367. Will be given half an hour, right? You need to answer 25 questions, right? Nityarachi, can you hear me? Nityarachi, can you hear me? You need to use the login password 6367. You can start now. Are you awake? Sixty-three, past 63, 67. 63, 67. You need to follow the examination rules and regulations, right? If you have finished, you can take the break once you have finished. Okay, finish. Right, you can take a break, right? After the break, you will start the next one. How many of you have over 20? 20 or above? 20 or above? Only one. Well over, basically. There's not difficult issues from there. Average 50. For that factor is signal out, you need to work hard, right? You have to get it from the exam, right? More work. You know that you are not but if you don't know that you don't have any idea about it, you ask questions, right? You don't have any idea about things that we discuss. Therefore, you need to do more homework, right? Be more committed, right? Final exam. How many? 30. Okay, after the break, right, we'll continue the lesson, right? So, from here, right, so we'll continue up to 12. So, take your break, right, and come to the lecture, right? Right? Can we start? Okay, yeah, I know how to define it. So we'll start the lesson, right? Okay, right? So now let's go back to the lesson, right? So now the exam is over, right? Now all the assessments, I think one individual assignment is there. That will be submitted early next week is the last day. Right? Because now we need to count at least 50%, no, from the continuous assessments. Right. So now this is the individual, now the MCQ test, right? So you know the marks you got, right? Standard you reach, right? So you can think about the readiness, no, right? For the final exam, you right? So now you must be keen, right? When you are up to the final level, right? You must know the subject areas, knowledge you must have, right? So some questions are given, right? Covering the several sections, right? Some are specific, focusing on the particular lesson and so on, right? So therefore, you must be so I have given you some tutorials also, right? How about are you doing those tutorials? Hands up those who done tutorials. I think I gave you four tutorials. And did you see the last tutorial? I uploaded. So you have to do the tutorials, right? So definitely compulsory, right? That is compulsory, right? So because some questions are clear to you, right? Even some ancient case, some equilibrium calculations, like multipliers and some questions here, right? There will be a similar type questions in the final exam. Now you know, right, the questions. So therefore, you get practice, right? And do some other textbooks. So there are some questions given, right? These things, right? At least we refer those materials, right? And the tutorials, these do all tutorials, right? So familiar with the subject areas. Right? So there will be once you have done the tutorial, that will give you some kind of confidence, right? In the final exam. So therefore, please do the tutorial, right? Otherwise, you will not be able to reach to the high standards, right? Now, this ISML model also very important, right? So there will be one or two sections from this area, right? So therefore, this is very interesting, right? Since this is somewhat combining the previous things and some kind of analytical model is going to be explained, right? So you will understand some of the things, right? It will be explained, right? The latter part we will talk about these policies and their effects, right? That's also very important. Today, I think we will finish this one, and there will be another additional lecture. I will say this was additional, right? One more lecture I have to do, right? To cover another topic, that is patient and target, right? Right? So we will finish this one, right? There will be another additional lecture, right? talk about this slope of the IS curve, right? So, now it depends on the two factors, right? So these are very important. You must know this, what are the positions, what are the slope of the determinants of the slope and so on, right? And what kind of what is the nature of the slope of the IS and then the right? So those are factors you must, right? So now here we talk about the slope of the IS. That depends on the inverse elasticity of investment. That is the slope of the investment function, and the marginal potential savings. That is the slope of the saving function. Right. Right. Now normally we know that the inverse elasticity of investment, right, can be high or low. Right? So that entirely, the slope of the IS curve depends on the one side slope of the investment curve. If the I1 is low, we know that investment curve is more steeper, right? So in that case, the IS becomes steep. Right? And if you have the inverse elasticity, high inverse elasticity, right? So then investment curve becomes more flatter, right? So that goes to have the flatter IS curve likewise. Right? And the same way, the NPS that determines the marginal opportunity savings, no, right? Which determine the slope of the saving function, right? So that is how much you allocate from your income for the savings, right? So if there is high NPS means, so even though there is more rise in the income, you allocate more for the savings, right? So that means we have the flatter. NPS, right? So if you know the savings curve, right? So that also depending on the income and the savings, no, right? Savings. If you, this is the income, savings, and the income, no? It can be steeper or flatter, right? Now this is the common point if you take, right? And if we have the flatter one, right, steeper one, we know that. So this is the steeper, right? So changes, right? Small rise in the income may lead to change the savings at a faster rate, no, right? So that means high NPS, no, right? NPS is high, no? And here NPS is low, low sensitivity. No? If there is a low sensitivity between the income and the savings curve become flatter, no, right? So that goes to the slope of the IS curve on the other side. Right? If we have the high NPS, we have steeper IS curve, right? So that means if we have the steeper savings curve, that is goes to have the steeper IS curve. Right? Graph, right? Now this is the investment savings and this is the investment savings and the IS curve, right? You can draw this curve, right? You can see this is the steeper IS curve, right? So we have the low sensitivity, right? So that means we have the steeper curve for the interest rate change, right? Investment change, right? So that means low interest elasticity of investment. Here, high interest elasticity of investment. If we have the low interest elasticity of investment, that goes to steeper base curve. You can see this relationship, right? With the explanation that extended in the previous, right? Related with the investment savings, and you can see the slope of these curves, right? So, steeper investment curve end up with steeper IS curve. Flatter investment curve end up with flatter IS curve. So you can see those relationships. So, yes, also, right? If we have the INPS, that means steeper savings function, right? So that will end up with steeper ISQ and vice versa. So those are the that determine the slope of the ISQ. Then same way we can discuss the factors that goes to shift the ISQ, the position. So the position mainly depends on three factors: government spending, taxes, investment. Now, if you look at these factors, all these factors are autonomous. All the autonomous expenditure, right, goes to shift the IS curve. Right? Now, for an example, in our equilibrium, right, equation, right, we know that I plus T plus X equal S plus T plus N. So this is the equilibrium, right? Injections. This is the injection, this is the withdrawal, right? Now, this is autonomous investment, right? Autonomous investment demand, right? We know that there is an investment function I naught, I1 R, right? This is autonomous function, right? So if there is a change in the autonomous investment, that goes to IS curve to shift, right? And the other one is government expenditure, right? So that also one factor, right? And the taxes here, taxes, we know that our tax function, we can write it as this way, right? So there is a autonomous part and the proportionate part, right? This is autonomous tax, right? So that also one factor that goes to shift the IS curve. So all the autonomous expenditure, right? Change the position of the IS curve, right? Apart from that, we can take exports, right? That's also autonomous. And autonomous imports also there, right? In open economy environment, those are other factors. Right? We are in a closed economy. Right? So if we take the open economy, we can identify other autonomous expenditure as well. No? Those are this is exports, entirely the autonomous. Import function, can you remember? We discussed the import function. Right? Import function, N0 minus simple Fy. So this is the autonomous import. That is also shifting factor. All these autonomous expenditure shift the IS curve. Right? So now since we are in a closed economy here, we take government spending, autonomous investment, and autonomous taxes as the shifting factors. Okay. But apart from that, we can identify export demand and autonomous imports as the shifting factors. Now, we know that these are the injections, no? Right? Government expenditure, if we take, no. Now these are the injections, no? Right? Which has a positive impact on national income. All these changes in this, all the autonomous expenditure will shift the IS curve to the right. Because if there is a rise in the government expenditure, there will be a positive impact on national income. Right? So therefore, shifting all these injections, right, factors, right, autonomous expenditure, goes to shift the IS curve to the right. So now these taxes, if we take, right, so those are the withdrawal, which has a negative impact, no, on national income. So if there is a rise in the taxes, what happens? That shift the IS curve to the left, right? Okay. So that way we can write it. So we can prove graphically, right, how these these changes in the autonomous expenditure affecting shift the IS. Right or left? So we can explain. For an example, right, now here government expenditure. Right? So this is our investment curve, right? This is the savings, right? Now here we write this investment IR plus G. This is not the investment. What is it? In the government sector, this is called injection. So this is the injection curve. Because simple economy we can take only a previous one, IR. Right? So that is the simple economy. I plus G means injection curve. Right? And this is the withdrawal curve, S plus T. Sy minus T plus T. Right? So that is the withdrawal. So based on that, we can derive the IS curve as a withdrawal economy. Right? Now here, if there is a rise in the government expenditure, right? So initial situation is we have the injection, IR plus D0, and we have the withdrawal, Sy minus T plus D0 level, right? And this is the initial situation, IS curve, right? Given by IS0. Right? And if there is a rise in the government expenditure, what happens? So that will increase the government expenditure, injections increase. That shifts the injection curve to the right. It's given by IR plus D1. Because government expenditure increase from G0 to G1. So rising injection shift the IS curve to the injection curve to the right. Right? So there is no change in this withdrawal curve. Right? Only the changes is in the injections. See there is a rise in the government expenditure. Now at the prevailing interest rate, what happened? R0 you take. Right? Earlier R0 is I0 G0. I0 G0 and associated S0 T0 is given by Y0. So this is the initial R0 Y0 is 1. Yeah, in this curve. Now after rising the government expenditure from G0 to G1, what happened? This curve shape, right? If you take the prevailing interest rate, that will increase the injections up to I0 G1. I0 G1. So the prevailing interest rate, now if you take I0 G1 is higher interest rate, higher injections, right? So I0 G1 as a withdrawal, higher withdrawals, this G0, right? So that is another level. So that will, since there is rise in the government expenditure, injection increase, national income increase, that will associate the higher income rate. So we have the R0, I0 G1 associated with this, and that will be given by Y1 over the so R1, you can take R0, Y1, right? So this is the in1 equation, right? So if we draw the IS curve, we can see IS curve. Shift to the right. If there is no injections, no IS curve shift to the right. So likewise, investment also change. No? If there is rising investment, this curve shift to the right. So there is no change, but we see shifting the IS curve in that. Right? So that way you can explain, right? Making this relationship. So if there is a rise in the government expenditure, IS curve shift to the right. If there is a decline in the government expenditure, IS curve shift to the right. So government expenditure is the fiscal policy variable, right? Fiscal policy variable. That is the mainly the fiscal policy highlight is expenditure policy and the tax policy, right? So raising government expenditure, that is called expansionary fiscal policy. If there is expansion of fiscal policy, injection goes to the right, right? That will shift the IS curve to the right, right? So this is the fiscal policy variable, right? Is it clear? Now if I ask you to explain this graph, can you explain? Huh? Anyone? Can you explain this graph? Can you try? Can you explain? Yes, I give you one chance. What's your name? Yes. Division. Okay, division will explain, right? Huh? So you can you explain? Right? How will you explain this? You are given this part. Suppose you are the linear agent. These are the I was in students. How do you explain? So what game is something? Does that come? So how you begin, how you explain the things, So how you explain the shifting the highest low to the down? Yes. You would say no, right? So the utility is here, right? You can explain, you can listen. So that will be added advantage. If you explain this here, that will be strongly in your mind, right? Those things, right? This right you can explain. Yes, absolutely. Asha. Harsha. Okay. Please explain. Right, actually, try to explain something. I would like to hear your voice first. Yes. You can't. Anyone? Can? So then if the question is given something, you need to explain the story behind this. Right? The story behind this. There is a big story. After the Corona, there is a big story. Right? You must know the story behind this. Right? Now, when you see the frame, no? Right? Behind this screen, there are a lot of things happening. Right? All the game hall, right? You see the live screening and the building, no? Right? But behind the screen, what is happening? So that's also important, right? Now here the piece is there, right? Capital, right? You see the graph, right? Behind that graph, what is really explained? You must know. That's it. Know that. Even though you go to the page, you are not seeing the field, no, right? Right? You are here, you are done, come here, sometimes, right? Behind this screen, what is happening? You must know. So that's very important. So you must be able to explain the things from the beginning. Changes, examples, some situations, European conditions, right? You must remember all these things, right? Okay. So it's not difficult, right? Now here we have given something here. What is it? What is this? Oh, දන්නවනේ. practical explain කරන ගොඩක් දේවල් අපිට විස්තර කරන්න ඕනේ නැත්නම් සමහර දේවල් you can imply, right? Something you can show that you are knowing something, right? By writing, right? What does it explain? What is it? What is this? As a minimum, I will give you a prize for that. What is it? What is this? Delta G 1 minus 1, no 1 minus this. What is it? Anyone? What is that? Sorry? So that is the Bayesian multiplier, no? Right? So that is the multiplier effect, no? Right? So this is the total effect, right? Due to change in the government expenditure. Delta G into 1 over 1 minus G is the multiplier. This is delta G is change. So the total effect, no? Right? And the prevailing interest rate. So if there is a rise in the government expenditure and the prevailing interest rate in the market, right? This is the impact. Income goes from Y0 to Y1. Here, that is the explanation given by Keynes and theory, right? Through the multiplier. Right? So, and the prevailing interest rate. If the market interest rate is fixed, right? If there is a raise in the aggregate demand for the government expenditure or investment, it leads to increase the income at a greater rate, no, through the multiplier. So the multiplier is given by the total effect is given by delta G into 1 over 1 minus C. Right? So that's the total effect, no? Not the NX effect. Right? But if there is a rise in the interest rate, we cannot see this thing. Right? Right? So that we'll discuss it. Right? We know that if there is a rise in the interest rate, what happens? That will alter the investment. Right? Then, even though the gains expected is multiplied, that will not seen, no? Right? there is some this effect weak, right? Maybe Amramani, rural remark, then there is a rise in the interest rate in the market. So that we equate. Right? But gains, sensibly identify the total effect on this. So if there is a rise in the government expenditure, it can increase from Y0 to Y1 due to the direct and indirect effects. That explained by the multiplier. Is given by delta G. If there is a tax, what happens? Tax is a withdrawal, no? Right? Now, if I write it in like Kurusakuli, right? So now earlier we talked about the government expenditure, no? Right? If there is a rise in the government expenditure, what happens? That will increase the aggregate demand, no? Right? Because aggregate demand is comprises C plus I plus D, no? Right? If the G increase, aggregate demand increase. When aggregate demand increase, what happens? Income increase, no? Right? Because we know that aggregate demand equal aggregate expenditure equal income, no? Right? So when income increase, what happens? What happens then? That will relate with the consumption, no? So when income increase, consumption increase, no? Because consumption is a function of income, no? Or disposable income, no? Right? When consumption increase, again aggregate demand increase, no? This will happen, no? Right? Right? So that explains the multiplier, no? Right? Why there is a total effect, why the income increase, no? Right? Y0 to Y1, no? Right? So that explains this process, no? Right? And right? So that will explain by the multiplier, no? Right? Direct and indirect effects, no? Right? There is a series of indirect effects generated through the consumption function, no? Right? When aggregate demand income increase, like consumption and everything, there will be a series of indirect effects coming from the that will explain through the consumption function. That explains this total effect, why the income increase from Y0 to Y1, given by delta G 1 over 1. Right? Now, if there is an increase in the tax, what happens? That tax. So tax is a withdrawal, no? Right? So that will shift the highest curve to the left, no? Right? Right? If there is a rise in the tax, no? Right? So now so that will change the withdrawal curve, no? Now if there is a rise in the tax, autonomous tax, what happened? When there is an increase in the tax, what happened? What is the next effect? It will affect to, yes, that will affect to the disposable income, no? YD, no? So if there is high tax, disposable income reduces because YD equals Y minus D. If there is high tax, disposable income reduces, no? When disposable income reduces, consumption reduces, no? Right? So that will affect to the aggregate demand to decrease. That will decrease the income, no? Right? Right. National income reduce, no? That there also this will continue, no? Right? Again, the consumption decrease, no? That also explains the multiplier, tax multiplier, no? Right? Always we see the negative, no? Decline. That's why the tax multiplier is negative, no? Right? There's a negative impact, no? Right? So all these things are finally explained by shifting the IS curve to the left, no? Right? So that's why IS curve shifts down to high taxes, right? Because taxes increase, no? So T1 greater than T, right? There's high taxes. So T1 is neutral. T0 is the there's rise in the tax and we will shift IS curve to the left, right? Okay, using this capital explanation, right? You can explain. Now that will affect your global, right? This is not changed. This is the initial situation R0, I0, D0. I0, D0 given by Y0, right? So that means I0, D0, S0, D0, right? So that is given by Y0, right? So R0, Y0 means this is the initial IS. Okay. So if there is a rising tax, what happens? That will shift the global curve to the left. So the tax increase from T0 to T1. T1 is greater than T0. So that will shift the global curve to the left. So this is remain unchanged. Right now, same point, right? If we take prevailing interest rate, right? R0, T0, but after the tax, it will change S1 plus T1. Right? Same. So at this level, if there is a lower income, right? Those naturally negatively affect on net income, right? Higher taxes. That's why it is well to the left. So we have given Y1 income and Y1. So R0, Y1, same point we can take 2 points. R0, Y1, T1, right? So you can see highest curve to the left. So graphically you can explain, you can see how these curves are moving, right? So when there is a change in the autonomous system, right? You can relate all these things. Okay. So finally you can conclude that if there is a high taxes that will go those are the lowers which has a negative impact on national income. So that will shift the highest rate to the right. Second factor. This one also you can take it same way, right? Like government expenditure, right? That's also injection, right? So, investment, if there is rising investment, there is injection, that will shift the highest rate to the right. So those are the shifting factors. Right? So we identified all the autonomous expenditure can be treated as shifting factors. Now, what is equilibrium? So that is so forth. We call it as macroeconomic equilibrium, right? Since this IS and the LM curve represent the two sectors in broader term in the economy, right, which combine the real sector and the monetary sector, this equilibrium is the macroeconomic equilibrium. That is more of the general equilibrium analysis, which we assume all other markets. Use, right? Now this is the IS equation we can derive based on this, right? Either injection is equal with low, low, y equals c plus I plus, right? That represents the IS curve, right? LM curve means money demand equal money supply, right? So equilibrium in the IS curve equals aggregate demand equal aggregate expenditure, right? We can write it as I equals C plus I plus B, or you can write it as I plus B equals S plus B. Right? And the LN curve equilibrium means you know that money demand equals money supply. Right? So this money supply is the real money balance, no? Right? Right? That is equals to the money demand which depends on income. So that is called liquidity preference. Right? So now we know that downward sloping IS curve, upward sloping LS curve, right? So the intersection point of the IS and the LF gives the equilibrium in the economy, that is the macroeconomic equilibrium, where the two markets, two sectors, the real sector and the market sector, come to the equilibrium. Right? So that is the stable situation in the economy, right? So this is the equilibrium interest rate, and Y is the equilibrium. So at this point, that will satisfy these conditions. So we know that aggregate demand equal aggregate supply, money demand equal money supply. That is equal. Both real sector and the market sector come to the equilibrium. Right? Okay. Now we can consider any other points. Right? What is the situation? This is our IS curve, right? Normally we take D0, D0, those are the exogenous variables. Right? If there is a change in those variables, that will shift the IS curve. Right? So, money stock is a shifting factor. And we know that autonomous money demand also there. Apart from that, now so far we assume we did talk about the price level. Right? So we assume price level is constant. Right? So then we can take the flexible prices as well. Right? Now here the price level is VC at a particular price level. Right? So if there is a change in the price level, that will also affect the LM curve because real money balance change. Right? Because if there is a inflation, no, we know that real money balance change before money stock change. Right? So therefore, we assume the money economy, the money stock is X0 and the price level is EC. Right? Okay. The section point A gives the equilibrium, where we have the equilibrium in the real sector and the monetary sector. Okay. Those are the things. We know that at equilibrium point, Y equal E, money demand equal money supply. And distance equal withdrawals, money demand equal money supply. No? Right. What is the situation in point B? Anyone can say point B. Point A is the equilibrium point. No? That is the macroeconomic equilibrium. So what is the situation in point B? Yes. You tell me. What is the situation in the what is the situation in the point B? Yes. You need to know, right? No, B, point B situation. Is it the equilibrium point? Why? Is it the macroeconomic equilibrium? No. Point B is the that lies on the IS curve. So that is the equilibrium in the real sector. But monetary sector equilibrium not there. Right? Only the real sector equilibrium achieved, but monetary sector equilibrium is not there. Right? So in order to equilibrium in the money market, money demand must equal. No, that should be the point on the LM curve. Right? But here this point B lies on the IS curve only. Right? So here at the point B we can achieve the real sector equilibrium, but money market equilibrium not achieved. So therefore that is not the macroeconomic equilibrium. So at the I1 income level is what the equilibrium is and the interest rate. The equilibrium interest rate. So that is the situation. Okay, you look at this one point B. Y equal E. Are you agree with that? In other words, how we can say that? Y equal E or aggregate demand equal E equal Y. And then we assume the other way around, injections would equal equal. Or we can say Y equals E plus I plus E. It's a crossing. Right? And at the point B, Y is not a money market equilibrium. Because it's below the LM curve. Below the LM curve, what is the situation? at the point along the LM curve, right? You know that money demand equals money supply. But any point below the LM curve, now this point B is below the LM curve. What is the situation? Below the LM curve, there is excess money demand than the money supply. We know the money market, no? Money supply, money demand, right? So, but any point below the LM curve, it doesn't excess money demand. So that is not the equilibrium in the money market. Any point above the LM curve, what is happening? There's excess money supply. Right? Any point below the IS curve, what happens? There's excess money. Excess demand for goods. Aggregate demand. Excess aggregate. Any point above the LM curve, there's excess aggregate supply. So, situation we can see. So at the point B, we can see, we can achieve that is equilibrium in the real sector or the market there. Demand, that on the point B, there's excess. The demand is greater than the supply. Okay. Likewise, you can see any other points. Now this point A is here, right? Not here, right? This point A should be here, right? So don't take it somewhere here, right? So there's a mistake, right? This is the intersection point, point A, right? If you take the right point here, what happens? What is the situation right here? If you take point here, no. Right now, right. If you take point A here, point B here, point C here, point D, right? So this is the equilibrium point, right? Now, what is the situation in the point A? What is the situation in the point A? Yes. According to the point A. So that is above the LM curve, no, right? Above the LM curve, there is a what happened? Excess supply of goods. See that. It's a supply of money, no, right? This is excess supply. Excess supply of money, right? And point A is above the IS curve. What is the situation? Point A is above the LM curve. There is excess supply of money above the IS curve. That is excess supply of goods, right? Excess supply of goods. That means aggregate demand is higher than, aggregate supply is higher than aggregate demand, right? So since there is excess supply of money, what happens? Interest rate should decrease. No? Since there is excess supply of goods, income should decrease, no, right? So this is not a stable point, no, right? Okay. And if the point B, if we take, what happens? Point B is below the LM curve, excess demand for money, right? That is called excess demand for money. Okay, point below LM curve, and above the IS curve, excess supply of goods, excess supply of goods. EX 0. 0 means goods, M means money, right? So since there is excess demand for money, what happened? There should be a rise in the interest rate. If there is excess supply of goods, there should be a decrease in the income, right? Okay. Point C. What is the situation? Point C is below the LM curve. Same way, there is excess demand for money, right? Okay. Point C is below the LM curve, excess demand for money, and also below the IS curve as well. So the excess demand for goods, no, right? Okay, I'm not writing it, right? EDM means excess demand for money, excess demand for goods. ED 0, right? Since there's excess demand for money, what happened? Interest rate should increase. If there's excess demand for goods, income should increase, no? Right? Right. So those are not stable points, no? Right? Point D, if we take, what happened? Again, above the LM, there's excess supply of money, no? And also below the IS curve, excess demand for goods, no? Right? So if there is excess demand for goods, that will raise the income. If there is excess supply of money, there should be a decline in income. Likewise, no, right? So, but at this point, we see there is no excess demand for goods, so excess supply of goods. Aggregate demand equal aggregate supply, injections equals withdrawal, right? So that is the macroeconomic equilibrium. Any other point? No. Equilibrium point, right? Okay. We can see other points, right? Status of the economy, right? What is happening, right? So those are our equilibrium points. Move away from the equilibrium points. Other points is there is no setting. Okay. So is it clear? Any question? If you have any question, you can ask. Okay, right? You must know the nature of the economy, right? Above the IS curve, below the IS curve, above the LM curve, below the IS curve, up to the section 5 as well. Like equilibrium point, you know that simultaneously achieving the equilibrium in the money market and the goods market. Yes, equilibrium. So that's why you have in the equilibrium analysis, right? We assume other market, that means foreign exchange market also. And what we talk about, right? Situation, right? So regarding the risk market and the money market, right? Asset market is the money market, right? Financial market, right? Goods market is the real sector, right? Real sector equilibrium, we know that we take this variable, simple sector. Money market, we know that money demand equals money supply, right? Finally, we talk about how the equilibrium income is. With this, we know that asset market, money market determines the interest rate, right? Through the interaction of money demand and the liquidity occurrence, right? Money demand and supply. Determine the effect on the income as well. interaction between the asset market and the cash market. The ISA. Equilibrium income, equilibrium interest rate. You can incorporate this model, right? So, to look at the policies, right? Okay. You can take the policy, fiscal policy one side, policy other side, right? So, the monetary policy effect on the money market, right? Basically, central bank change the money supply and the interest rate. Right? So, as part of the monetary policy, right? Central bank control the money stock. Right? So, they come, this is the monetary instruments, and also using the policy rates, central bank control the market interest rate. So, this is the monetary policy basically affects the money market. And the fiscal policy, that is budgetary policies, especially, right? The government expenditure and the taxes that affect this, right? This market, this variable. So these policies affect the variable, as we discussed in macro variable. Fiscal policy will control the variable, macro variable. Monetary policy control the monetary variable. Finally, interaction between these variables, the relationship affects the equilibrium and determine equilibrium income and equilibrium interest rate to the ISA. Now, next step is we are going to talk about its policies. How we can explain the ISA. Is it clear or like do you can understand what I am saying? Right? Can you understand? Yes. We have any difficulty or something? That is the way now. This is the we have the we need to complete this one, right? Right? The syllabus these are there, right? We talk about these are very interesting, and you can think about when you talk about these policies and so on, right? You analyze the effect on macro variables and so on. Right? So one day you will realize that for exam purposes we are going to incorporate these things, practical situations as well. Thinking the effects of these fiscal monetary policies through this model, right? How it is affecting other macro variables. Any questions? We are going to talk about the fiscal and the monetary policies, right? Now we talk about the shifting factors and so on. Right? You can explain it, right? That knowledge, right? Fiscal policy basically we take the government expenditure policy or the taxes, right? And the effects. Those are the shifting factors of the fiscal. Monetary policy means money supply basically, right? So that affects the LN curve shift, right? So then it will change. So you must be able to relate the relationship, how it is impacts, right? Now first we take the fiscal policy. Mostly we take only the most time we take the government expenditure policy. You know that fiscal policy can be either expansionary or contractionary, Expansionary means if we raise the government expenditure, that is expansion. If we reduce the taxes, that is expansion. Contractionary means reducing the government expenditure, raising taxes. That is contraction. So can assume now based on the assumptions. So you look at the impact on the equilibrium income, interest rate, right? So far we talk about those two areas. Then once we derive the aggregate demand, aggregate supply, based on this, we can assess, we can evaluate the impact on the price level as well. The next step is that actually then we go to the open economy environment as well. We are not going to talk, right? So that is called Monday training model. In the open economy environment, we can talk about the impact on the exchange rate as management questions. So those are the nations. Right? Now, here we will just look at the impact on income, interest rate, and we look at the impact of the price of the asset. We are not going to talk about open economy market. It's a nice film, right? So, and we will show you the way, right? So how it is affecting the variables, how it change the macroeconomy. Right? Before moving to that, right? Now we can we need a break your body. Small 5 minutes break. Right. Okay. Right. Now we assume now this is the first one, right? Now we assume the fiscal policy, right? We assume the government raises expenditure, right? Let's assume government raises expenditure from G0 to G1, right? Under the fiscal policy, right? Now what happened? Now this is our ISLM, right? R and the Y, right? This is our IS curve, downward sloping. This is our LM curve. No? This depends on the money. We assume price level is constant. IS curve is depends on the government expenditure. Since we take the government expenditure, right? And taxes also we can take it, no, right? So this determines the intersection point, gives us the equilibrium. Initially, we have the equilibrium income Y0 and the equilibrium interest rate R0. Right? Now, when the government raises expenditure, what happens? So I plus D equal S plus T. So that will increase the injections, no? Right? So that means IS curve shift to the right, no? Right? If there is a expansion fiscal policy, the IS curve shift to the right, no? Right? Given by IS G1, no? Right? Government raise expenditure from G0 to G1. So this is the change in government expenditure, no? Right? Okay. So we see here what happened. Interest rate increase, income also increase. No, right? So when there is an expansion of the fiscal policy, if the government raises expenditure, what happened? If the market freely operate, there is a rise in the interest rate, no, right? Because you can think about that. Income level also increase from Y0 to Y1, right? So why there is a rise in the interest rate? Why there is a rise in the income, right? So the interest rate increase, why? Income increase, why? So that is the story behind the screen. You need to explain that one, right? Okay. That we are going to explain. Right? Now we can highlight this point also. Right? That's another thing, no? Right? So at the prevailing interest rate, no? Right? Now if you look at, firstly look at here, right? Now this is the based on the Keynesian cross, no? So this is the aggregate demand and the aggregate supply, right? We need to turn other side, right? Okay, now this is the aggregate supply curve, 45-degree line, no? Right? Aggregate demand curve, right? Now here we take the aggregate demand, changing factor is the government expenditure. We can write it as here aggregate demand C plus I plus T, no? Right? So this is the equilibrium point. we have the equilibrium income Y0, and here it's given at a particular interest rate, no, right? Investment is at a particular interest rate, so we assume R0, right? Right, that is the goods market, no, right? Real sector, no, right? Now, if you look at the money market, this is the money market situation, no, right? Now, in the goods market, we see the equilibrium at Y0 income level. Right? When you go to the money market, so this is the money demand, right? Right. Downward sloping, that is liquidity preference curve. No, money demand depends on the income. Money supply curve, no, that determines the interest rate and the real money balance. No, MOB means real money balance. That is the money stock. No, so the money market is in equilibrium at R0 interest rate. Goods market is in equilibrium at Y0 income level. Economy is in equilibrium initially. Now the government raises expenditure. Let's assume government increase expenditure from G0 to G1. Now, at the initially, now we can see the ISLM, right? So at the interest rate, so we know the particular income Y0, right? So we can identify the ISLM at the same equilibrium, right? Where it explains the money and the goods market equilibrium at the same point, at the point A, right? So we can see the goods market, money market, and ISLM explain the reflection of the goods market and the money market, where both markets, both sectors or the both market come to the equilibrium, right? Real sector and the market sector. So we have the equilibrium income Y0, interest rate R0, right? And the government expenditure G0, right? Price level also P0, and the money stock also P0 at the initial stage, right? So now the government raises expenditure, what happened? That shift the aggregate demand curve upward, right? When the government raises expenditure given by delta G, right? So the equilibrium move from here to here, right? A to B. Income increase from Y0 to Y2 according to aggregate demand, aggregate supply, right? To the multiplier effect. From Y0 to Y1 explain the Y0 to Y2 explain the multiplier effect according to the Keynesian theory, right? So according to that, income should increase from Y0 to Y2, right? Point A to B, right? Now we can take when there is a rise in the government expenditure, that is injection, right? Injection curve shift to the right, right? So IS curve shift to the right, right? As a result of that. So IS curve shift to the right given by IS1. So that is at G1 government expenditure. Earlier G0, now government raises expenditure from G0 to G1. So that shift the IS curve to the right, right? Okay. What happened when there is a rise in the IX curve, right? So that means if we take the same point Y2, right, at the prevailing interest rate, right, if we assume the interest rate does not change, right, income should increase from Y0 to Y2, according to this, right? So that will explain the multiplier effect, right? So why the economy moves from A to B due to the Keynesian multiplier, that explains the through the government expenditure multiplier, right? So that can be explained as delta G into 1 over 1 minus D, right? But when income increase, what happened? Actually, the money demand increase, right? So this story not come to an end at this point, right? Y2, there is a further continuation, right? That need to be analyzed by looking at the money market, right? Because when there is a due to rise in the government expenditure, those money flows to the public, right? Therefore, their income increase, right? Maybe the government expenditure, government transfers money, right? When the government expenditure increase, that money goes to the public, right? So that their income increase, that means money demand under the transaction and precautionary motive increase. So that means money demand curve shift to the right, right? But when there is a rise in the money demand, we know that money supply is constant, money demand increase. that create imbalance in the money market, no? Keep creating excess money demand at the prevailing interest rate, no? Right? So therefore, there should be a change in the interest rate, no? Because money supply is constant. There will be a pressure on interest rate to rise. So when there is a interest rate rise, we know that money demand under speculative motive decrease, no? Right? So we know that interest rate increase until this excess money demand comes to zero, no? Right? So there is a rise in the interest rate from R0 to R1, right? Okay. So when there is a rise in the interest rate, what happens? That will reduce the private investment, right? So there is a crowding out effect, right? Due to rise in the interest rate, right? Actually, higher interest rate uh, reduce the private investment, right? So that is given by the intersection point C, right? So that is the intersection point of the IS and the LN, right? So even though we expect income increase from Y0 to Y2, due to these money market adjustments, right, income increase from Y0 to Y1 only, right? Not as expected by gains from Y0 to Y2, right? So finally, the economy come to the equilibrium at point C, not the B, point C, due to the money market adjustments. Right? Since there is a rise in the interest rate. When the interest rate increase, investment demand increase, that reduce the aggregate demand. That's why the income reduced from Y2 to Y1, right? Actually, this decline in the income from Y2 to Y1 explain the crowding out effect. Right? Because when the government raises expenditure, how this expenditure is financed? With the borrowing, right? Government borrow from the market, right? Or issuing treasury bills, right? Private sector funds will tied up in these treasury bills and treasury bonds, right? Money flows private sector to the government, right? The money available for the investment increase, right? So that's why private investment increase. That's why we are moving from Y2 to Y1, right? So Y2 to Y1 explain the crowding out effect. Net effect is due to this expansion and fiscal policy action, income raised from Y0 to Y1. So finally, we see the equilibrium established, because at this point the money market also equilibrium established at R1 in interest rate. Equilibrium income is Y1, right? Okay. So due to these adjustments, what happened? So due to this expansion in fiscal policy action, income increased from Y0 to Y1, interest rate increased from R0 to R1. So this story, explained there. Right? So you need to, when you explain this one, right, you need to incorporate the real sector, goods market one side, money market one side, right, in order to explain this, right? So now this actually explains the total effect, as we mentioned, delta G into 1 over 1 minus D. So why the income increased from Y0 to Y2? Because of the Keynesian multiplier. Right? So, but finally, due to the adjustment in the interest rate, when the interest rate increase, right, money market rates adjusted, right? Therefore, there will be this is called crowding out effect. Because this money comes from the private sector to the government, right? If the private sector purely operate, right, without government, right? So there is no adjustment in the interest rate. If there is no adjustment in the interest rate, income increase from Y0 to Y2. But due to adjustment in the interest rate, because when the government demand money in the loanable fund market, there is an adjustment in the interest rate. Government demand money from the public. Demand for funds, right, increase. When the government increase expenditure, right? So government also demand money in the fund market. So that will raise the interest rate. So that's why interest rate increase, since there's excessive demand for funds, right? Okay. Now, can you explain this story? So the expansion of fiscal policy, right? What happened to the income and the interest rate? behind the screen, because the story, this is the story. Using the money market, and you can incorporate money to explain this equilibrium. You can incorporate money demand function, adjustment in income and interest rate. As we discussed earlier. So why the equilibrium established here and we come to YC where there is equilibrium in the money market. So that can be explained using the money demand function as right. So we'll try to explain, right? So incorporating this vertical analysis, right? Okay. So is it clear? If you have any question, do I need to repeat it again? Yes. Right. So that is the net increase, right? We see here. Right. What is it that will be another right. So what it is starting out today, we can think about it. Because one side government raises expenditure, right? Response coming from the private sector to the government. Right? So normally we know that private sector and the government sector is not very efficient than the private sector allocation. So that's why it is a different income. So this money allocated for the recurrent expenditure of the government, right? Not the capital investment. So that there will be an impact on the long-term income. This money allocated for the elections are coming from, maybe it goes for the rights, right? Transfers, right? For the political campaigns, right? What happened? One side borrow the domestic market, right? The government unlimit the borrowing for the domestic market, the international. But those money come to the election campaign and so on, right? Giving the rights to the transfers, right? Leaves, right? This recurrent expenditure, right? It's not productive use, right? So there will be a long-term impact on the economy, right? So that is the message. So you can think about it, right? Right. Then that is the fiscal policy, right? You only take the government expenditure. You can think about the taxes also. Same way, right? Right? So that also affected the highest level. So this is the fiscal monetary policy. So here we assume the money stock change. Right? So money stock, there is expansion in the monetary policy government. So the central bank increase the money supply. Right? So liquidity in the market. So this contraction in the monetary policy, central bank control the liquidity. Central bank reduce the money supply. Tight monetary policy. So one by here, tight monetary policy. So what happens if there is a increase in the money stock? If there is expansion in money supply, we know that will shift to LN curve. Now what happens? The other way around. LN curve shift to the right. You need to look at the story behind that, right? Now, if there is a monetary policy, what happens? This is ISLM, no, right? Now this is LM M0, right? R0, Y0, right? Now we assume money supply increase from M0 to M1. No? Central bank raised this money stock under expansion in the monetary policy, no? Right? So that will shift the LM curve to the right, no? Right? LM M1. Right? So what happened? You see there is a decline in the interest rate and increase in the income from Y0 to Y1. So how it is explained? Why there is a change in income? Why there is a change in interest rate? How you can explain? Behind the screen, right? Just to look at You can incorporate the money market, right? Because it's monetary policy, right? Initially, they have the money demand, money supply, even money stock, and then they determine the real market, right? So there is the liquidity, no? This is the liquidity in the market. At a particular income level. So we assume income level is Y0, equilibrium interest rate is R0, money market is in equilibrium at point in the ISL rate, right? So we have the ISL, right? So then 0, right? And then 0 money stock. Price level we assume constant for time being, right? Same equilibrium point. Same percent of employment. Both real sector and the non-real sector are equilibrium. Now the central bank raised the money stock. What happened? The central bank is expanding the monetary policy. So the money supply increased. Right? So that's it. Like with the right. Now we see here the money supply. What happened? Money demand is constant, right? Money supply increased. There's excess money supply in the market. Money market is this equilibrium situation. If there is excess supply, what happened? There will be a decline in the interest rate. So we see the interest rate increase from A to B. When there is a decline in the interest rate, what happens? Money demand under the speculative model increase. That will absorb the excess money supply. Finally, money market comes to equilibrium at point B by equating money demand and the money supply. At the point A, at the prevailing interest rate, once the central bank raises the money supply, that creates imbalance in the money market because by creating the excess money supply. Right? So there should be adjustment in the demand side. Right? Since there is excess money supply, there is a decline in the interest rate. As a result of that, money demand under the speculative mode will increase until it absorb this total excess supply. That's why at point B, money market comes to point. Now what happens? Central bank raise the money stock from M0 to M1. That shift the LN curve as well. So M0 to M1, LN1, right? Right. Then shift to the right. So equilibrium established at the point B. So income level here increase. Right? So why there is a rise in the income? Now you see the interest rate a decrease, right? That you can observe in the market, right? So if there is a rise in the money supply, right? What happened? That that reduce the interest rate, no, right? Because it create excess money supply in the money market, so that will reduce the interest rate, no, right? That will reduce the interest rate, right? Since there is a decline in the interest rate, what happened? That will increase the investment demand. That will raise the aggregate demand and income. Right? So that's why we see income increase from Y0 to Y1. So you can relate with that, right? So we see as a result of this expansionary fiscal policy action, income increase from Y0 to Y1, interest rate decrease from R0, right? So that is the monetary policy and okay. We are going to finish, right? So many things are there, right? So the time is how we will stop. We have the another lecture. Shall we do this one also? And we can. At what time we have the next lecture? One. So we will finish this one. We will continue from next year onward, right? And we will finish this one, right? So if there are any questions, right, you can call me, right? So you have my number, right? So you can WhatsApp me, but I cannot type it, right? So if you call me, I can explain the things, right? In a free time, right? Okay. Otherwise, you can do the tutorial in the last lesson, right? I will just briefly highlight some of the things in the tutorial, right? So you may come up with your answers, right? Right. So I want to know whether how you answer the question and so on, right? The last lesson, right? So I will give you some more questions coming from this area, right? Please practice and you must know the story behind this, right? Okay. So thank you very much. We'll meet next time at the extra lecture if there is a problem.